Welcome back here with MF Corner. So I asked a lot of people on Twitter what they wanted to learn about, and I got a lot of requests from investors wanting to know about REITs or real estate investment trusts. Well, in its simplest form, a REIT is a vehicle which invests in real estate or property. So, it will buy one or two or few big properties which are beyond our budget and allow us a chance to benefit from the income generated by that or those set of properties by investing smaller amounts. But nothing is ever simple, right? So let me invite Mrin Agarwal, who's a financial educator and director at FinSafe India, to lay bare the workings of a REIT. Hi, Mrin. Good afternoon. Good to see you in the new year. So tell us, have you done a SWOT analysis of REITs? What do they mean for investors? What are the peculiarities? And, what class of investors are they suitable for?
Good afternoon, Samara. Nice to be here on the show today. REITs are fairly nascent in India right now, but given that the minimum amount for investment is being brought down to 50,000, it is becoming popular in the sense that more people are wanting to at least look at it. Now, obviously, it is easier to take real estate exposure through a REIT because of the amount that needs to be allocated is going to be much lesser. When you look at REITs, they also help you diversify. Buying one property on your own, you really won't get too much diversification. I think one of the other reasons that people are looking at REIT is because of the stability of income that can be expected from the REIT. So given that 80% of the portfolio needs to be invested in developed and income generating properties, and 90% of that income needs to be paid out on a regular basis, means that it's a good way to also get into an instrument if you're looking at some good regular income. So those certainly are the advantages of the REIT. So those are the advantages of the REIT.
Mrin, given the year that we had, 2020, practically everyone is working from home. You are too, I can see. Is there this whole outlook on commercial real estate seems pretty cloudy, right? We've just about started going to malls. They've just about started getting back on their feet. I don't know, what's the kind of rental income they're generating. Is this an environment in which REIT is still suitable? Is the outlook positive? We don't want somebody to put in 50 grand ahead and then only to find out that it's not doing so well.
Well, probably for maybe this year and maybe the next couple of years, there might be some impact. But I think, from the overall perspective of office space, and given that I live in Bangalore, where there's a very high demand from IT companies, I think, the overall long-term perspective is pretty good. Maybe on the short term, there might be certain issues. Although when you look at the two REITs and what they have said, they say that they have really not faced that many issues. But yeah, there might be some short-term challenges.
Okay, Mrin, how would a REIT differ from a debt mutual fund? Are they targeted at the same investor?
Well, I think first and foremost, of course, REITs invest in real estate, whereas debt funds invest in bonds. And clearly, REITs are meant for longer-term investors because when you invest into a REIT, it's pretty much for long term. You're not going to invest in it for a couple of months. So first and foremost is that. Secondly, when you look at the costs, debt funds today are extremely low cost. Even the longer term debt funds are very low cost, below 1% TER typically on debt funds. If you look at REITs, there's a 1% on the distribution and there's a 3% on the property management as well. So certainly costs are higher in REITs. Again, when you look at the tax structure, so there are 2-3 elements out here in a REIT. You would be getting dividends, there might be interest, and there might be repayment, and of course, capital gains when you exit. So each of them is taxed differently. So the dividends are tax-free. That is provided the REIT has not taken concessional taxation. The interest is taxable. Repayment, so let's say the REIT exits a property and makes a repayment, that is tax-free. I think all of this can get quite confusing. Also, when you look at the capital gains, so long-term capital gains kicks in after 3 years and it is taxed at 10%, whereas short-term capital gains is taxed at 15%. So I think, the tax structure is quite complex. There's a portion of the income that's going to be taxable. There's a portion of the income that's not going to be taxable, right? So this was really on costs and tax. I think when you compare the risks that are associated, one of the risks that could be there in a REIT could be the concentration risk, which is that the REIT invests only in a couple of properties. As far as debt funds are concerned, of course, SEBI has laid down guidelines on the exposures limits that can be taken by debt funds in various categories. So clearly, I think the concentration risk could be a risk. Of course, the risk of the economic downturn and everything that you mentioned about, that may not be there in debt funds.
True, got it. Okay, Mrin, unfortunately, we've run out of time, but we promised to, get you on the show again, and we'll do another more detailed chat on REITs. But for the moment, thanks very much for joining us.